Welcome to this week's episode of Accredited Investor Markets Radio. Each week, we speak with you about investing in alternative assets. Unbiased and beholden to no one, Accredited Investor Markets Radio does not accept advertising from any investment firm or financial advisor. Accredited Investor Markets Radio is the spoken word sister of AccreditedInvestorMarkets.com, the internet's most comprehensive and unbiased educational resource about crowdfunding, angel investing, venture capital, private equity, private shares, and other investment classes beyond publicly traded stocks and bonds.
Hello, everyone, and welcome to Accredited Investor Markets Radio. I am Christopher Cahill. In a few, we'll talk with Drew Mason of Dillon Gage Metals about gold. Gold is trading at a lowish amount these days, but Mr. Mason is bullish about bullion. But first, let's talk about India. Microsoft is run by Satya Nadella of India, the subcontinent, obviously. Google is run by Sundar Pichai. One study has found that 15% of all Silicon Valley startups in 2012 were led by Indians, even though Indians compose only 6% of the area's population. So when India's Prime Minister Narendra Modi visits Silicon Valley, he should be asking himself, why hasn't India been able to replicate, in some small measure, Silicon Valley's top-end technology ecosystem? These observations are made in a Bloomberg View article dated September 23, 2015 by Giraj Nayar entitled, Why Doesn't India Have Its Own Silicon Valley? Well, indeed, why doesn't India? They seem to have a lot of talent coming this way. So there's a lot of talent to be had, and there's capital in India. Why not? According to the article, India spends only 0.8%, less than 1% of its GDP on research and development, compared to 2.8% in the U.S. and 1.8% in China. Both U.S. and China have much higher GDPs than India, so a lot more cash is simply going into research and development in those two countries. Until recently, Indian startups attracted limited venture capital and private equity funding compared to their Chinese counterparts. And we note that intellectual property protections have historically been weak in both places. But maybe things are beginning to change. And I base that observation on a different article, an article from Tech in Asia, a publication I recently discovered and have talked about on prior programs. The piece is entitled, Here are the 7 most active investors in India this year, dated October 15, 2015, written by Malavika Velayanikal. Of course, I apologize for murdering anybody's name. I'm trying my best here. I hope the author calls in and instructs me. It'd be interesting to talk to Velayanikal. Anyway, the report, the important thing is the data. 2014 was a watershed year for fund flows into India's starting ecosystem. NASSCOM, which is a software industry body, says that the country is on course in 2015 to see a doubling of 2014's funding level for startups incorporated since 2010, from US $2.2 billion to US $4.9 billion. There's a growth in seed stage funding as well, 6 times higher in 2015 than in 2014. 400 startups have received funding already this year, more than double the number in 2014. This is all within India. So who are the most voracious among the active investors in India this year? The author identifies the top 3, Sequoia Capital, Tiger Global, and Accel Partners. These are all U.S. companies. Sequoia Capital is from Silicon Valley, and Tiger Global is from Silicon Alley in New York. So that's what's happening in D.C., according to Tech in Asia. It's starting to really build in India. Well, other things are happening in India. Prime Minister Modi is presented in the financial media here in the United States as poised to overhaul the Indian economy. Well, good luck with that. It's a difficult project in any society, let alone a society as huge and variegated as India. But one of the things he is allegedly trying to overhaul is the Indian bankruptcy laws that date back a century. The point is to make it easier for creditors to get their money back or to get realization on their collateral. This is reported in Bloomberg Business, an article by Vrishti Baniwal entitled India Targets Central Bankruptcy Law to Revive Momentum. This week, and this is in October 2015, this week a government-backed committee plans to submit recommendations to the Finance Ministry for a bill that may be tabled during the Parliament session starting next month. Again, to slash the time it takes to wind up a dying company or recover dues from a defaulter. Well, your host, that is, I am a commercial bankruptcy lawyer in Chicago. And I can say that the idea of reforming bankruptcy in order to help move capital from unproductive hands into productive hands is indeed a very key aspect of any vibrant economy. And so the Indian government may be on the right track. There's one other aspect of this article I found interesting. Companies in India, and I'm quoting, companies in India now can only get help if they've been operating for at least 5 years. They are declared, quote, sick, end quote, only if they've accumulated losses exceeding net worth, and identified as ailing if they lose 50% of value or fail to repay debts for 3 consecutive quarters. Why is sick in quotes? Is that a term of art in Indian law? A sick company? Yes, it is. I looked at Investopedia. The Sick Industrial Companies Act of 1985 was enacted in India to determine the extent of sickness in industrial units and expedite the revival of potentially viable companies and close unviable units to release investment locked up in them for productive use elsewhere, almost like a MASH unit in which doctors are performing triage, deciding which ones are viable, which ones are unviable, how sick is this one, etc. Well, I suppose it kind of works as a metaphor. Sick, healthy. I can't help thinking of the first Star Trek series and the inimitable Dr. McCoy, but let's imagine him as a lawyer, a bankruptcy lawyer in India, saying, or being asked by the captain, is your sick company going to get well? And lawyer McCoy responding, I'm a lawyer, Jim, not a doctor. Let's get to the interview. We are here with Drew Mason of Dillon Gage Metals, worked on Wall Street for 15 years after completing his studies at Wharton. He was a founding partner in the Palos Harbor Fund, which is believed to be the world's first physical gold income fund. He has written about and conducted interviews on precious metals via numerous media channels such as Forbes and Business Insider, and is the author of Victory from Defeat. A few words about Dillon Gage Metals. It's one of the world's largest precious metals wholesale trading firms. The company is an authorized purchaser for all major world mints and maintains inventory in over 20 countries. Dillon Gage Metals also owns International Depository Services Group, or IDS, which operates 2 secure precious metals depositories in Delaware and in Ontario, Canada. The company also services dealers and individuals through FizTrade.com, that's F-I-Z as in Zebulon, trade.com, which offers users a real-time bid-ask trading platform for gold, silver, platinum, and palladium. Thank you, Drew Mason, for joining with us today.
Thanks so much for the invitation to be here, Chris.
Awesome. Okay, some history questions. Do precious metals correlate negatively with the public equity markets? That is, when one goes up, does the other go down?
Great question, Chris. Key to portfolio construction for most Americans, and we would say very underappreciated. So what we looked at to study this question specifically was how gold has returned relative to large cap stocks from 1971 through last year. And the reason we picked that period, those 44 years, is that that is the period during which gold has traded freely in the U.S. So it's really the only appropriate window we have to compare the returns and answer your question. What we found is that the two have a correlation coefficient of negative 24. And the conclusion would be that gold and large cap stocks have a statistically negative correlation.
Well, all right. And we'll talk a little bit more about the implications of portfolio construction in a moment. But while we're on the topic, you mentioned the magical year 1971. Do precious metals, including gold, correlate negatively with the strength of the U.S. dollar?
Again, we would say that is a critical concept for people to understand with their portfolios. And again, going back to the early 70s through the end of last year, we found that the correlation was even more negative, negative 65, where the conclusion would be they have a statistically very strong negative correlation. When one goes up, the other goes down, and vice versa.
And indeed, in recent years, gold has gone down and the dollar has strengthened just in the last few years. Now, what about you? We mentioned 4 precious metals in connection with Dillon Gage: silver, platinum, palladium, and gold. Do they march in lockstep with one another as regards the U.S. dollar or public equities? Do they just march in lockstep with each other?
From 50,000 feet, unlevered real assets do well uniformly as paper currencies depreciate. But there clearly are differences. What we would say is that gold and silver in particular are differentiated versus platinum and palladium. And the reasons for that is the majority of platinum and palladium demand is industrial, largely from the auto sector. So the end market for these is tied to economic strength. So if you're thinking that you want to have real asset exposure and that the economy is going to recover, and think of burgeoning car demand throughout China and Asia, then platinum and palladium likely would outperform gold and silver. If, however, you're looking at your precious metals as a hedge versus your other, let's call them risk assets, stocks, bonds, real estate, then gold and silver are a more appropriate hedge. And the reason for that, gold in particular, is a financial asset. It is a currency. But it's a currency that cannot be debased or cheapened by a central bank. So if you look today at the world's major currencies, the dollar, the yen, the euro, the pound sterling, you can even add in the Chinese currencies, each of those nations has balance sheets that are significantly levered and indebted. And what we've historically seen is that when economies weaken, central banks and governments choose to print money by increased debt to maintain stability at the time. And as they print money, it's simply supply and demand from classic economics. As they print the paper money, the relative value of that paper money vis-a-vis other assets depreciates. But gold and silver are recognized as monies by central banks, by the fact they trade in the foreign exchange markets, not in the commodities markets, by the Constitution of the United States, which declared they're the only legal money in this country, through literature dating back to ancient Greece and ancient Rome. So we have this consistent, long history that gold and silver are money. As a result, in a weakening economy, we would expect gold and silver to outperform platinum and palladium.
Well, then I have 2 questions, and maybe each of them is ill-conceived. Starting with your more recent point. Now, the Federal Reserve has purchased immense amounts of assets in recent years, and thereby, according to some descriptions, pumped immense amounts of dollars, not paper money literally, but the equivalent, into the economy. So there's a larger supply of dollars, and yet at the same time, over the last 3 years, the price of gold has dropped. How explain that?
Okay. So you're absolutely right. Since 2011, gold has traded down significantly. and silver as well. And when you say, well, why is that so? It goes back to the reasoning of why would you own metals? You own metals because they are diversified relative to traditional assets that are held in the majority of American portfolios. Like we talked about at the top of the show, stocks, dollar cash, inversely correlated. Now, the time to really own gold, then, is when you expect those other assets will perform poorly. But in 2011, the Fed became emphatic in telling the world we were going to manage our way through this crisis. It's largely behind us. That is saying we're going to be responsible with our balance sheet and that there is blue sky ahead of us. And people have bought this. If the Fed has your back and there's no reason to worry about the equity markets because every time they sell off, the Fed is there, then there really isn't a major reason to own the metals. And so the consensus of investors clearly is not worried to a great degree about the markets. You look at allocations to equities. You look at the way financial advisors have positioned their clients, and they are comfortable with the risk reward. They're looking at the scenarios and they're saying, yes, there's a lot of debt. Yes, there's literally a half dozen hand grenades rolling around the global world stage, and if any one of them go off, it's going to be a significant impact. But they're saying it's okay. The Fed has our back. And in that environment, there's not a need to have gold. But I believe it is largely the buy-in that the Fed has gotten from investors globally that has caused people to decrease their allocations to gold and has contributed to the price selling off as we've seen it here in the last several years. Now, what I would say to you, though, Chris, too, with equal candor, is that if you look at our situation today, nothing's been fixed since 2011, and nothing's been fixed since 2008. $50 trillion in incremental debt globally since the crisis, and you can't fix a debt crisis with more debt. And so what seems probable to us, and at the end of the day, investing is about probability, right? There are no certainties. But what seems probable to us is that we're in a period right now that was a little bit like the mid-'70s. If you think back to that period, the 1970s, the decade started out similarly to what we have today. Low interest rates, low inflation, and as the government started to print more money for social spending and war spending, inflation started to rise. And as that happened, gold and silver started to rise, as we saw at the beginning of this cycle. But in the middle 70s, gold traded down 50%. 50%. At the end of that period, in the mid-'70s, people were saying gold is the most stupid asset. There's no reason to have it in your portfolio, even though throughout that pullback in the mid-'70s, the fundamentals for gold continued to strengthen.
Mm-hmm.
We think that's the period we have now. The fundamentals have continued to strengthen, but the idea of an efficient market hypothesis is ludicrous. It's an inefficient market in reality. And what is happening is people's psychology is such that they're not worried. And so they're not allocating to gold. Today, gold is less than 0.5% of global wealth. So there clearly are not allocations to gold. That reality played out, and people saw that the fundamentals had continued to improve. The government hadn't fixed its debt situation. Gold ran up, and by the end of the decade, it was up 24 times, where the stock market had been hurt badly. The S&P multiple had been cut in half. Bonds were bludgeoned. And so we think that there's a probability that that's where we are now, that this cycle from 2000 to 2011 isn't over, that this is the mid-cycle pause, as we still have fundamentals that are very supportive for gold and silver. And we think we're going to look in the rearview mirror at these entry points today and to say it was incredible that investors were given the gift that they were to be able to buy at these prices. And that's our view on that.
All right, let's pull back then from that larger point to a smaller point. I just wanted to pick up something you said earlier and just ask you quickly about it because, well, obviously the gold issue is looming very large. You connected platinum and palladium as industrial metals, offered the hypothetical that as car sales strengthened, therefore platinum and palladium should strengthen if the demand is high for for vehicles that require the use of those metals. Well, the news lately is that in the U.S. anyway, car sales have been very strong in 2015. Has that been reflected in the prices of platinum and palladium?
Well, what I would say to you, Chris, too, especially if people are looking at short-term events, right? So here we are in the middle of November, and last week, economic report said we're off to the races, jobs numbers good, et cetera, et cetera. I think that answer was best articulated by Stan Druckenmiller, who I think most of your listeners will know, a self-made billionaire. And he condensed all of the barrels of ink that have been spilled on this topic into a very simple phrase. He said, because of QE, all prices are distorted. Equity prices, bond prices, real estate prices have been distorted. He is saying that they're distorted higher than they should be, where the government is not involved.
Overvalued.
That's right. That's right. On the flip side, it would suggest that gold and silver below fair value. And so as you think about that, it doesn't take a rocket scientist to figure out if there's an artificial intervention in markets, which is what QE is. You want to be very leery of buying the assets that are being artificially stimulated, and you probably want to think about the attractiveness of assets that are being negatively impacted. And people may say, well, how are they being negatively impacted? Clearly, going back to your original question, which is key for people to understand, stocks and gold are inversely correlated. So as are stocks and bonds. We didn't talk about that, but stocks and treasuries are also negatively correlated. So if QE is supporting the purchases of equities and bonds, again, it reduces the need for gold, and so the price is artificially lower than it would be if that QE was removed. So there is something that our government is doing for investors that we think, again, we're going to look back in the rearview mirror and say what a great opportunity it was to buy at those levels over time. Again, there are no guarantees, Chris, as I think your listeners appreciate, but historically, when you've seen government intervention, like we're seeing today, it has been good to lean into the wind and to buy the assets that were undervalued were it not for the government intervention.
Drew, your carefully composed and analytical depiction calls to my mind anyway, a comic metaphor. And that comic metaphor is drawn from the old 70s TV show, as it happened, Monty Python's Flying Circus, in which, in one sketch, the housing crisis, the urban housing crisis in Britain was to be addressed by the intervention of a magician, an actual magician with a cape and everything, who would wave his wand and up went buildings where people could live. And it solved the problem of urban housing in Britain, but only for so long as people believed in the magic. They would be sitting in their flat, and if they started to express doubts, the whole building would start to shake and ultimately crumble. I thought of that because of your depiction of the Fed intervening and pumping money into the economy by buying assets, and thereby making everybody think the Fed has our back, equity prices will continue to be supported. However, it could very well happen that that perception could become loosened. Couldn't it?
It certainly could, and not only perception, Chris, but think too about the history of what we've experienced. One of the greatest investors of the 20th century, Sir John Templeton, had a very important and famous quote that I think all of your listeners would be well served to recall. And it was 4 simple words. He said, the 4 most dangerous words in investing are, this time it's different. And so today we have many in finance saying, because of the Fed, because of this reason or that reason, it's different. You're not going to see a major impact from our debts that are essentially unpayable today. And what we've seen through history is that that's not the case. It has been consistent. When a country and a currency become overly indebted, it's only a question of time until the purchasing power diminishes in those currencies and that wealth transfers to the metal currencies, which cannot be debased by a bank, namely gold and silver. And so, again, going back to investing as being a game of probabilities, Here we have an enormous probability that this is what's going to happen based on data from ancient Rome, just to the 1970s when the dollar was decoupled from gold. In every instance that we've ever seen, it points to there being wisdom in diversifying one's cash portfolio into gold cash and not relying entirely on paper cash, as is the case with Americans today who virtually have 100% exposure to the U.S. dollar with their cash allocations.
Right. So even in a situation where a person believes, maybe not to the extent that you believe, but a person might believe that what goes up must come down, maybe not as dramatically as the scenario you're pointing out, it makes real sense. You might, it's been argued anyway. I'm not taking a position. AIMkts does not take a position. But to follow the argument, it makes real sense to take a 10%, say, portfolio allocation into precious metals as an insurance policy against the collapse of equity markets. How might that work and help somebody stave off dramatic misery?
Okay, well, let's just back up for 1 minute, though, Chris, and say we're not talking about Armageddon and the reason to have that. We've had, just looking in our own lifetimes, in the United States, to have an allocation to gold cash has dramatically outperformed dollar cash. And if we look in our lifetimes at how gold has performed versus equities in our lifetimes, it's also been admirable. So this is about risk management and diversification, because nothing ever goes up forever. And that is essentially the way investors are allocating today, showing no concern for what are natural corrections. And when those corrections occur is when people are historically extremely happy that they have physical gold allocations. So you say, well, what does support an allocation to it? I pulled up a couple quotes that I think, again, may benefit your listeners. Ben Solly and a group of academics researched pension portfolios. So these are not small individual investors. These are sophisticated institutions with, in most cases, dozens of either full-time financial professionals or those combined with boards, advisors, etc. And what they concluded is that even at that level, the traditional approach creates portfolios that have 90% of their portfolio variance driven by just equity risk. So even at the pension level, there is very minimal diversification. Another study by Shaves and Dennis went even further, and they said that even if you diversify a portfolio among commodities, equities, high-yield credit, real estate, and bonds, it barely gives better diversification than a simple 60-40 equity bond portfolio. You say, well, what possibility is there to appropriately diversify? And the answer is with gold, because gold does impact such a portfolio in a major way. So the dynamic supporting a 10% allocation, or a level that's particularly appropriate to an individual investor, is the fact that gold is non-correlated. So it is the allocation you would expect to thrive when the others do not. So we would say to people that we think it's wise to think about your gold allocation in two layers. There's an insurance type non-correlated layer that you probably want to always have in your portfolio. And then there's the potential for a second layer, which at times can be 0%, and at other times can expand if you expect gold to outperform traditional assets like it has at various periods throughout history. So between both the insurance level layer and the opportunistic layer, we think the dynamics are very clear that an allocation to gold is a sage move.
Well, all right. Let's just go back a few years then, because maybe you've essentially answered this question already, but I think it bears a little further discussion. So maybe 3 years ago, there were some of them were political critics of the current administration, and others were simply commenting on the market, who suggested that the policies of the Fed were going to cause massive amounts of inflation. Therefore, even at a price, say in early 2012 of $17.50 an ounce, gold was a good play in the second sense that you were talking about, as a way to simply have your asset appreciate. Well, it went from 750 then to 1093 now. Have you already explained what intervening events said, how people maybe didn't understand the true implications of the Fed buying on the effect on the price of gold and other assets?
I think that we touched on that, Chris, with regards to our explanation, but maybe you'd like to look at it another way. And from this perspective, not so much the cause and effect of it, but what if gold continues to go lower? So let's address that, because that certainly is a possibility, just like it has the last 4 years. What we would say to people is, think about your own homeowner's insurance policy. Every year that goes to zero. Your health insurance policy, every year that goes to zero. But you really would not think about not investing in that again, because the risk is so huge if you ever need it. Now, statistically, we all know that your homeowner's policy, there's well under a 0.1% chance that you're ever going to need it. But you still allocate to that. With gold, it's essentially an opposite bet. With gold, history says there's a virtual certainty that you are going to need it. As is the case with homeowners, we don't know when it's going to occur. We think there's probable timelines and that the probabilities are increasing that you're going to need it sooner maybe than later. But the reality is, this is your allocation to wealth protection. And if it continues to decrease in value, then most investors shouldn't be extremely upset about that, because that means the vast majority of their assets that are non-correlated in equities and bonds and real estate are doing fine. And that probably means that our government and society are continuing to function in a very, very normal way, which everyone would probably like to see continue. So what we would say is, you're doing this for a defensive purpose primarily, and not as an aggressive moneymaker. And in that sense, if gold goes down and it continues to be non-correlated as it has the last 4 years, then that should be fine with investors who have even a 10% allocation of the asset class.
Not a tremendous weakening of your returns.
That's right. The flip side, though, is if you don't have that allocation and something should happen, one of those exogenous events should take place, which by definition we can't articulate today and we can't time. It's like if you have an event at your home and you don't have the insurance policy, you really can't then go back out and get it and protect yourself sufficiently. So it's important that everyone understand their own risk preferences and tolerances. And if such a potential loss is something that would be extremely damaging to an individual, then we think it makes all the more sense to allocate to this class. If people aren't concerned at all, which is again what we think we're seeing in the markets today, there's no real allocations towards defensive assets, then that's the type of investor who will only be concerned with return and may not want to allocate to this class. You have to know yourself and how you'll respond to the different situations.
Well, all right. So why don't we talk about Dillon Gage a little bit? Dillon Gage is a great success, obviously. Everything to be proud of in your endeavor. But could you just sort of take us through who your typical clients are? I mean, the comments you've made on the show are obviously appropriate to any investor. But who are the typical investors at Dillon Gage, and what is it they want from you, and what is it you provide them?
Historically, the core client for Dillon Gage has been the coin dealer. We support hundreds of them around the country and around the world from over 30 locations where we maintain inventory. We offer them seamless service for delivering to clients wherever the clients may be. We allow them to trade directly online with us or to access a desk that is staffed around the world so that clients can lock in on prices, whether it's in midday in Asia or at the open here in the United States. We also allow coin dealers, we allow the clients of coin dealers to trade online directly with us if they should so choose through a white labeled product that we have called PhysTrade, which has become the world's largest physical gold discount trading platform.
Wow.
More recently, we have been getting interest from independent financial planners and family offices who historically have not had any exposure to gold. And what has happened is these financial planners have seen their clients withdrawing capital from their brokerage accounts and coming to places and buying it directly, the physical. And it has led them to ask, can I maintain client assets and do them a service by upgrading their allocation from an ETF, which is how most financial planners have historically expressed interest in gold, to buy the physical directly. And so we have crafted a platform for boutique financial firms that allows them to do just that, and where we're able to upload to the financial firms data that we report the positions so they can track it as part of their client portfolios and on their client statements. And with family offices, we are able to customize delivery according to their preferences around the world, and to do so at prices that are extremely competitive compared to the ETFs, while not having the derivative exposure that financial instruments do with the gold allocation, and to give them customization that otherwise they could never have. And what we're seeing is family offices take a deep dive with us on these correlations that you led off the conversation about.
Yeah.
They realize that it is very prudent for them, who have so much to risk given their success to date, that it is prudent to have allocations of this class. And so that has been an increasingly important end market for us.
Well, Drew Mason of Dillon Gage Metals, thank you for that extremely well-ordered discussion. Really appreciate it.
Thank you so much for having me, Chris.
Well, this has been Accredited Investor Markets Radio. Accredited Investor Markets Radio is produced by Stephanie Strait. Thank you for listening. Let's do this again sometime.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.AIMkts.com. Each week, Accredited Investor Markets Radio brings you news and education about investing with a focus on alternative assets. To see a short written summary of this episode, go to www.AIMkts.com. Accredited Investor Markets Radio is a production of Financial Poise Radio Productions, LLC.